Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I did a podcast last week, which is now available with Van Culler. Basically, I did a one-on-one interview discussing the history of Vancouver real estate, the household debt bubble, the secret bailout in 2009 through the Canadian government, Chinese capital flight, macroeconomics, etc., etc. It's a really good podcast, about an hour long, so if you want to check that out, so far the feedback has been really good. There's will be a link to that in the description below, so I highly encourage you to check that out. I'll also be on Nicola Wealth Management's podcast next week, so once that comes out, I'll also update you and post links to that as well. And last but not least, I did a private event with a bunch of brokers at RBC Dominion Securities. I've done a number of these, but it's always interesting to have these conversations with these individuals, because very sophisticated people obviously know what's happening, what's going on in the financial markets. But I had to do a housing presentation to them, and part of building a brand and through that is you have to create authenticity and have a consistent message. And so whatever I tell them is the exact same thing as I'll share in these videos. And my message to them was, as I went through the slides in the Vancouver real estate market, I ended off the last slide. I said, Vancouver housing is stabilizing, but likely more volatility ahead. That was basically my message to them. And so I'll sort of run you through that here today. But again, this is to individuals that are managing significant amounts of money, particularly to high net worth individuals. So I think that they take the data and the research very, very, seriously. And so for me, that's something that I also take very seriously, to be able to have that honor and that privilege of providing information regarding a particular subject matter. And so what we're seeing today is basically this reflation in housing markets. And so it's important to understand, we're looking at Vancouver, that Vancouver is not, despite what the industry might tell you, Vancouver real estate does not work in a vacuum. It's not really come down to supply and demand. It's not why home prices rose 30% annually. We didn't just all of a sudden run out of supply and prices jumped 30%. So these things never work in a vacuum. We have to look at global markets. And so what's happening right now is central banks are essentially all in a fight, a race to zero. Everyone's in a race to cut interest rates and basically devalue their currency. There's not one economy that really wants to have their currency appreciate. And so of course we can see all the tweets and whatnot from Trump, who's saying, US is having the greatest economy ever, record low unemployment, and by the way, we need to cut interest rates by 100 basis points and restart quantitative easing. Those don't really go hand in hand. So everybody's trying to devalue their currency, and as a result of that, we're seeing bond yields fall, mortgage rates and interest rates come down, and that's providing some stimulus to households who are really stretched, not just in Vancouver, but globally. Housing markets have become very, very much unaffordable. Incomes have failed to keep up. So this relief in mortgage interest rates has spurred some home buying activity, not just in Vancouver, but in many other global markets. And so all we have to do is look at, Sydney, Australia, which everybody likes to compare to. Obviously, huge household debt bubble, huge Chinese capital flight there. They're dealing with a lot of the same problems. And what you can see here is I actually think they're further ahead than us. Their auction clearance rates, which is basically their sales volumes essentially, have ramped up significantly. And so the chart here basically implies that prices should rise significantly from here, which basically work on a lag from those clearance rates. But interestingly enough, even the Australian economists said, the most bullish ones suggested that that likely wasn't going to be the case. But we're also seeing it in US pending home sales. Those had a nice bounce in July. So there's definitely some could, spurred activity from these lower rates, but it really begs the question is, how long is that going to be sustainable? So as I said in the beginning of this video, I said, stable for now, but likely some more volatility. And that's really, the question that I think the market is going to be facing here in the next 12 months is yes, we have these low rates, but, there's a lot of volatility and there's a lot of things happening in the market today. So we have, significant geopolitical risk. Obviously, we know what's happening with trade wars, Hong Kong, Europe is an absolute disaster. And a lot of the world is trending towards global recession. And that's part of the reason why every single central bank out there is cutting rates, including the Bank of Canada, which will be cutting rates likely within, I would say, by October. I mentioned in this video last week that the consensus from Canadian economists from a Bloomberg poll was that the Bank of Canada would be on hold until the end of 2020. Well, funny enough, as soon as I released that video, a couple days later, Scotiabank, which is basically, consensus, forecaster, their economist basically came out and said, oh no, we're actually revising our forecast. We're no longer, late 2020. We actually see the BOC, the Bank of Canada, cutting interest rates twice, potentially potentially a cut even as soon as September. So these guys took a hard pivot, and it really, the writing was on the wall. I mean, again, the Bank of Canada certainly doesn't work in a vacuum. All you have to do is, as the global economy slows down, Canada slows down, and we inch closer and closer to what appears to be a global recession, which again, obviously is not going to be bullish for many assets other than gold, and certainly utilities, maybe yields, which, well, we don't need to get into that today. But so that's kind of what's happening today. Is basically, yes, again, stable for now. I'm certainly not going to be the one that's going to say I'm predicting a recession, because that is certainly very difficult to do. But I think the probabilities of a recession are certainly elevated. And so, I look at that and say, okay, well, if we have a global recession, certainly not cheering for that. I don't think that's good for anyone's prosperity. But if you have a global recession, how does Canada shape up? How do we look? We know that home prices are elevated. We know that Canadian households are extremely indebted, and we know that Canadian household saving rates are actually the lowest they've been since 1961. So Canadian households are sort of acting or assuming that the good times will continue to roll on, and there's nothing to really worry about. Keep spending, keep leveraging up, and just keep the party going. And obviously, of course, we know that central banks have been encouraging that behavior through, basically, we have negative rates already, at 1.75%, that's a real negative interest rate. They've been encouraging that activity, and unfortunately, due to other global factors that are out of the Bank of Canada's control, they really don't have a choice. They have to follow other central banks and cut interest rates. Because all our economies are so interconnected. Even the IMF has put out reports showing global home prices move in tandem, particularly in cities such as Vancouver, Manhattan, Toronto, Sydney, etc. These global markets are intertwined. The financial markets are what now move economies because we have become so financialized. So that's basically my thesis. That was my thesis to the guys at RBC, and that's kind of what I'm looking at today. I think that we'll see a pretty significant bounce here in activity for the month of August in Greater Vancouver, and I'd imagine certain other pockets of Canada. But I am concerned about the probabilities of a continued slowdown and what that will mean on housing activity moving forward, because certainly it becomes a lot more difficult to leverage up if you get laid off a job, and certainly the banks will be less enthused about lending money in a recession. So that's kind of how I'm looking at things today. But anyways, hope that video helped. Otherwise, see you next week.